Hello everyone, welcome to today's US Open live session. It is Thursday, January 25th, 10 minutes before Wall Street opens. As always, I am your host Nikos Tabouras, Senior Financial Editorial Writer, FXCM. It has been a very exciting couple of days since our last session, with Netflix impressing, Tesla, on the other hand, underwhelming. That's as far as the stocks front. While on the data front, the US economy continues to overperform, as today's GDP figures showed, and focus now shifts to the critical PCE inflation update. Of course, the day's main event is the European Central Bank, which stood pat once again and not offering much new. So these are the main themes we will be covering today. But as always, before we begin, please read carefully through the links and the risk disclaimers, and then we begin. Once again, please go over the risk disclaimers and the risk warnings carefully. I'll give you a few more seconds to do that, and then we will go ahead and begin and start. Okay, let's get the ball rolling. We have quite a few things to cover. Of course, we're going to start with the European Central Bank and the impact on Euro USD. Then we will go to the Nasdaq, the tech-heavy US index, and talk about the outlook there, given strong data, GDP data today and tomorrow PCE inflation update. And we're going to talk about Tesla's outlook, given the underwhelming results that it posted overnight. And we're going to talk a little bit more about the US inflation at the end of our session. Now we already have Euro USD on our chart. We're seeing that it is facing some pressure. Let's start with what the ECB decided today. So the central bank had refrained from hiking in the last two meetings and had hinted that the terminal rate has been reached after, of course, a tightening program of 450 basis points, but has generally pushed back against aggressive market rate bets. Today stayed on the sidelines again, as widely expected, and the statement did not change much in regards to next steps, reiterating the need for maintaining rates at current levels for a sufficiently long duration. The inflation reference seemed to soften a little bit, as the statement read that the declining trend in underlying inflation has continued. Of course, we know that we have talked about it again. Core CPI fell to 3.4% in December, and that's the lowest in nearly a year. Now, President Lagarde's press conference is still ongoing, but right off the first question she was asked about a rate cut, she said that the Governing Council considered premature to discuss such moves today, and she also stood by her recent comments that essentially said that lower rate that the bank could start lowering rates in the summer. Now, on the technical front, and we have the 4-hour chart here on our screen of Euro USD, the pair remains at crossroads, technically and fundamentally, actually, and it seems to be in a no man's land around the 200 period EMA, the black line on the chart, and the 38.2 Fibonacci of the last leg up. The moderated expectations around both central banks don't allow the common currency to rise, and the January decline, along with the pressure that we're seeing today during Ms. Lagarde's press conference, keeps the pair vulnerable to 1.0722 support. However, we are not convinced for sustained weakness here, and you can see also the blue line on the chart, which is the 200 days exponential moving average, which can provide support. But the pair is definitely in a precarious position. On the other hand, the Fed is more dovish in terms of rhetoric and likely to cut first, given that commentary that we have seen. This may give the opportunity to the common currency to push for the 1.1 handle, although the next level at 1.1144 is definitely distant. So that's pretty much the take on Euro USD and what we saw today from the ECB. Again, the press conference is still ongoing, so we could see volatility. It is in a no man's land at this stage, the pair. And of course, as I said, we expect key events starting from tomorrow. We're going to talk about that later. If there are any opinions, we'd love to hear them on what we're discussing. Or if there are any questions, again, feel free to type them in the chat box. Now, with 2 minutes before Wall Street opens, let's go to the Nasdaq, which jumped to new record highs yesterday, helped, of course, by the strong results of Netflix, who saw another acceleration in both revenue and subscriber growth. And of course, it also announced its entry into live sports with the WWE Road deal. And that I have been saying for many months now that live sports is probably the next battlefield for streamers. Now, in any case, back to the Nasdaq 100, it finds renewed vigor today, probably because we got strong GDP figures just earlier. We had 3.3% GDP growth for the fourth quarter, according to the first reading today, much higher than expected. So the economy continues to outperform. And at the same time, we had weak durables and a pickup in jobless claims, which still was somewhat low. These data are a bit mixed, but they seem to reinforce the market expectation for a soft landing scenario and don't seem to dissuade them from anticipating multiple rate cuts this year. Now, the technical front, frankly, it's a bit dull at this stage. Obviously, the index has the ability to tackle the 18K handle. That's the reasonable expectation here, but we have key incoming events, which include also next week the Fed and big tech earnings. Some of the companies that drove last year's rally. Now, on the other hand, the index may be ripe for a pullback, perhaps back towards the 17K handle, but a strong catalyst would be needed for the crucial 200 period EMA to be challenged. Again, we're in a 4-hour chart here, as you can see. Generally, I prefer to focus on the 200 period EMAs, either 4-hour or dailies, to sort of provide support level, also a distinction between bullish bias and dovish bias. Of course, the bias here is clearly bullish, but daily closes below the 200 period EMA could shift bias to the downside. Now, let's talk about Tesla. They've had a mixed 2023 against, of course, an adverse external environment for the EV market in general. And of course, is facing also competition to try to catch up. Elevated interest rates in most of the Western world make funding for such vehicles costlier, while cheaper makers from China start posing a threat, especially as they expand into Europe and other regions. And BYD, for example, sold more electrified vehicles last year. However, in terms of pure battery electric vehicles or BEVs, Tesla is still ahead. Of course, in order to cope with dented demand, Tesla resorted to multiple rate cuts, which have harmed its profitability and slowed its revenue growth. On the other hand, the Model Y was the best-selling car last year, Tesla's Model Y, while Q4 deliveries and output picked up again in the last quarter, setting new records. And actually, let's take a look here at the deliveries. You can see that they went close to 500,000 in the fourth quarter after a disappointing drop in Q3. Of course, we talked about the fact that demand for EVs in general and Tesla's vehicles is dented, and this output delivery gap actually alludes to that, as well as Tesla's ballooned inventories. Okay, back to the charts. And now, yesterday's results were definitely underwhelming. Revenues rose by just 3%, the smallest in more than 3 years, while operating margins remained below 10% for third straight quarter. Of course, if you have any opinion on the results or Tesla or anything else, we would like to hear your opinion for sure. Markets reacted negatively to the results and mostly to Tesla's warning that volume growth could slow this year. And of course, they sent the stock lower. It should open in a little bit. And let's go to Tesla's chart actually, so you can see now it opens testing the 109 handle, dropping around 9%. That's the negative reaction to Tesla's results, which were reported overnight. Now, on the other hand, the reason for this potential slow in volumes that the company is preparing to launch a next-gen low-cost model, which for me is the big bet given the current environment and something that could fend off cheaper Chinese EVs and other established legacy automakers like Volkswagen, who has already announced such a model for the upcoming years. We got some more color around it from Mr. Musk in the earnings call because he said production in H2 2025, and generally rather optimistic. Tesla is already updating its aging lineup with the Cybertruck, the refreshed Model 3, and it is rumored that it will also this year move to a refreshed Model Y. It is also pushing on multiple fronts, including artificial intelligence, self-driving, and humanoids. So definitely all of these things put Tesla in a strong position despite challenges. And again, probably most important is getting right the low cost. Now, in terms of the chart, the stock has been dropping this year. We can see that here. Let's highlight it. So this here is the current year. We can see that it's a sizable drop, and it actually crosses the October lows. And that, of course, exposes it to the next support level at 152.37, although the 2023 lows are distant. The 2023 lows are located at around $100. Now, on the other hand, the stock doubled last year, and the correction has been relatively low, relatively shallow for now. And a look at the RSI shows that it is in highly oversold levels. Most oversold since the 3 low. And that, of course, then had been the impetus for a significant rebound. So this scenario could play. Of course, Tesla will need to reclaim the 200 days exponential moving average at around 230 to pause this downside momentum, and that will allow it to challenge the 300 mark, which is the highs from the summer. But we are a bit more cautious around further strength past that point. Now, that is pretty much it for Tesla, and let's round things off with what's ahead. Of course, there are a slew of earnings coming up next week. We got Ryanair, the Irish airliner, and then it's mostly US tech. We have AMD, who is trying to catch up to NVIDIA in the AI revolution. And of course, we have Microsoft, Apple, Meta, and Amazon, 4 of the magnificent 7. And most of them were the main drivers behind last year's rally for the tech sector and Wall Street in general. But let's talk about what is this week, and it is the US December PCE inflation tomorrow, Friday. Inflation in the US has been decelerating, and you can see this in the PCE after hitting 40-year highs in the summer of 2022. It has been dropping, but there has been some persistent as well. Below with the black line is the core PCE, who had hit similar such highs as well, and has been dropping as well, but not as fast. The CPI release earlier this month showed persistence, that's for sure. Now, as we said, we expect the PCE, the Fed's preferred measure of inflation. Core had moderated further in November to 3.2%, as you can see on the chart. And headline had eased to 2.6% and the lowest in almost 2 years. Signs of stickiness would keep pressure on the Fed for sustained restrictive stance if we get a sticky print on Friday, and could delay the timing of the first cut, with market already pushing back and see this now in May instead of March, but with 50% chances. And of course, let's not forget that the labor market remains strong despite signs of despite coming to better balance. While the economy is in good shape, yesterday's preliminary PMIs alluded to, and today's GDP first reading for the fourth quarter was really strong as well. Of course, the Fed announces its decision on Wednesday, that is next week. So that's pretty much it from me for today. We will talk again